Hey guys, Michael Beresford here. Welcome to today's Wealth Workout of the Day, Property WOD. Love talking about finance. Finance is what we're going to be talking about today, with a few specifics around loans, applying for loans, fixed loans, so on and so forth, in response to questions that we've had in recently. The first thing to think about when you're looking at your finance is to make sure that you're in a position to be able to get equity out as that equity is created, because without that, you're stuck on the portfolio you have, you're not able to duplicate. Okay. Now, fixed loans can be a really, really good thing. They give you certainty of repayments. They also help with affordability if interest rates are going up and you can fix at a certain level. However, they can give you some inflexibility. And the numbers suggest that obviously the banks employ people far smarter than me and all of you guys on economic policy to be able to set those fixed rates, because they still make a profit on them. They're billion-dollar institutions. Okay, so make sure that you're fixing for the right reasons as opposed to trying to beat the bank. Now, the main limitation of fixing loans is not that you can't get equity out, but you're limited in the options that you can look at. So let's say, for example, that here's a property and it's grown in value by this much since you last had it valued. Okay, so you've got equity there that you can look at, but let's say this loan here, or part of it, is fixed. And let's say that that loan is through ANZ. Okay, you can tap into this equity, no problem. However, you must go back to ANZ to be able to get that loan. Okay. Now, what if ANZ give you a randomly allocated valuer that gives you a poor valuation? The handbrake is on. You don't have opportunities to be able to go to different lenders and explore better valuations to unlock this equity, unless you're prepared to pay the break fees on the fixed loan. And that can sometimes be several $1,000s depending on what the rate was that you fixed at and what the fixed term was on the loan. So it can be very costly, you can get out of it, but it does give you less flexibility. While we're talking about banks, recently, a few years ago, CBA and Westpac went on a bit of a buying spree and acquired other lenders under their banner. Okay, so the most common one, I guess, is Bankwest. Was bought by CBA, and people are curious to know, well, can those two banks share information? The answer is that they can't. So if you have a loan through CBA and you have a loan through Bankwest, and you go back to CBA and apply for an equity release, for example, then they can't share information on that application with other banking brands that they might own. Okay, so everything is kept separate and secure. The one final thing with loans to be really cognizant of is your credit file, because the banks do a credit scoring exercise as part of the assessment process when they're looking at giving you a loan. Now, don't want to scare you guys. You can obviously apply for finance and you can have a few inquiries on your credit file, but you don't want to have one that has a lot of inquiries in a really short space of time. Even if they get accepted and approved, then they still get registered on your credit file. So it's important, if you're looking to do refinancing, by all means do that. By all means pull the equity out. And you could, 4, 5, 6 credit inquiries in one go is going to be no problem. Any more than that, you're going to be starting to register on the credit file, which may or may not, depending on all of your other circumstances, affect your ability to get a loan in the near future. So hopefully that's been useful. A few points around finance and how to make the most of getting your equity out to get your next property.